Hello everyone, welcome back. I got some really good ones for you today. But first, I hope you had an awesome holiday season, an awesome new year. Welcome to 2023. Hey, you made it. I would say the last couple years have been a bit of a dumpster fire, whether you're in the market, out of the market. I want to even say rich or poor, given that Elon is, seeing about 100B from his portfolio evaporate over the year. Mark Zuckerberg losing about 75 billion for 2022. So everybody's taking a gut check in one form or another, whether it's asset prices not behaving as you'd like, or inflation just getting out of control, or wages not keeping up, or maybe some lingering shortages, or what have you. So been a difficult last couple years, but hey, looking to the future, I'm trying to be optimistic, and I would suggest the same for you. You made it this far. Let's get to the point where we've gone from surviving to thriving, and I think we might start to see that, at least for some camps, in the next couple years. We got little one joining us this evening, so she might weigh in on interest rate hike expectations, market rhetoric. We'll just kind of see if she's got any idea of what's going on. But that's little one. So let's dive right in, shall we? Markets. The three major U.S. stock indices, kind of give or take where they were about 3 months ago. The Dow Jones is markedly higher. It was about 30,000 a few months ago, now hanging out around 33,000. So I wouldn't say, bubbly and a frenzy, but I would say kind of defying gravity, given all this hawkish rhetoric we've been getting out of our institutions over the last year or so. So the Dow Jones kind of doing its thing, nothing really crazy there. S&P 500 quite flat over a 3-month period as well. So Dow Jones up about 3,000 points in 3 months. S&P 500 about where it was 3 months ago. NASDAQ down a little bit because of the interest rate sensitive tech sector kind of getting beaten around by these rising bond yields, hawkish rhetoric. So tech has a little bit of ground to make up, but nothing crazy. The market crash callers haven't really, seen that come to fruition, and the market bulls who have been beating their fists on the table complaining about the Fed and inflation aren't really seeing what they're looking for. Kind of leaves the truth somewhere in the middle, and markets are just a collection of opinions. So everybody's opinion kind of leaving us in the middle wondering what's coming. So been a very hawkish year for market bulls. We have a Fed that has raised interest rates like at every meeting up to 75 basis points at a time. They're insisting that the terminal Fed funds rate going forward is going to be like much higher, maybe 4.5 up to like 5.5, 6%. Citigroup coming out today, kind of their economists forecasting that the markets have really underestimated the Fed's seriousness about raising interest rates to get inflation under control. However, as little one continually reminds me, Citigroup is actually, generally in my experience and hers as well, a good contrarian indicator. So whenever Citigroup is telling you to buy something, you should seriously consider selling it, and whenever they tell you to sell something, you should consider buying it. I'd say the same goes for Mark Cuban. I remember in November of 2021 saying that, for cryptos, all indicators from technicals, fundamentals, sentiment were hyper bullish, to excluding that Mark Cuban was also bullish Bitcoin, and I should have taken that as a good contrarian indicator, and lo and behold, whenever Mark Cuban is telling you he likes something, generally he's dumping that position. And whenever Mark Cuban says that he hates something, there's a good chance that he's trying to get the best, lowest possible price to load up the boat on. We also have Kevin O'Leary, pretty good indicator inverse, meaning whenever Kevin O'Leary gets super excited about something, I tend to want to treat it like radioactive waste, and whenever Kevin O'Leary is talking down something, I generally want to flip bullish. So Citigroup, Kevin O'Leary, Mark Cuban, great contrarian indicators. Their record is pretty good. So just a little nugget, something you can kind of start to monitor. And if Citigroup is saying that the Fed is going to get really serious about fixing inflation over the next couple of years, then I say they're not. I say inflation is going to remain a sticky, challenging issue over 2023 and 2024. But that doesn't mean that risk assets can't go up. That doesn't mean that wages can't go up. That doesn't mean that we can see some improvements to the economy. The economy does remain weak. Survey participants are all looking for a challenging 2023, 2024. Really doesn't matter who you ask. Real estate especially concerned about these mortgage rates hanging out in the 6-7% range. They really don't want to see those mortgage rates move higher because that really crushes demand even more, and then eventually prices. I will say the Fed's done a pretty good job over the last year or so crushing demand, but prices and inflation has remained a sticky issue. The Fed would need to raise interest rates much more to cull inflation. The Fed would need to set capital requirements for banks, or some institution would need to do that, requiring large investment banks, institutions to hold a certain amount of cash on their balance sheet. Right now, their capital requirement is 0. So the Fed would need to force institutions to hold cash. That would fix the inflation problem. And the Fed would need to roll off its balance sheet. So other than really putting all their weight on, raising the overnight rate between banks and saying that's going to fix inflation, that's really what the narrative that the Fed has been running with. But, realistically, the Fed would need to do a lot more to get inflation under control. They know this. They ultimately don't want to create too much deflation. So they're kind of trying to tell the market through rhetoric, using their number one blunt tool of just kind of managing expectations through their words, saying, we're going to keep raising, we're going to keep raising, we're going to keep raising. But the market generally defying gravity, because as the Fed becomes more and more hawkish, the market seems to kind of shrug it off. Maybe not shoot to the moon, but not crash in the way that all these crash callers are waiting for. We're in a recession, okay? So we're already there. When you have 80% of survey participants for these massive surveys saying, I'm anticipating, more financial pain in my day-to-day life, well, I mean, you're already there. But, CNBC is not going to come out and talk about a recession 20 times a day. It doesn't engender confidence. So the mainstream media is going to keep kind of telling you, look, everything's fine, inflation's falling. And they're just going to kind of run with that, and we're going to keep just kind of slogging through the next couple years. Now, I am happy that the pandemic is behind us. There are, some issues around how to kind of, I don't want to say anything because I'll probably get another strike and have my channel banned. But other than some issues with the, we're pretty much over the pandemic, and I would expect things to slowly start to get better, but inflation to remain sticky. That's just kind of what I see going on, but I could be, completely wrong. As far as cryptos, we have Bitcoin down in the dumpster at like 16,800. Tentatively bullish crypto, because all we're doing is waiting for the Fed to be done with these interest rate hikes, then begin to need to cut interest rates again in order to stimulate a slowing economy, and that's going to be the next bout of inflation. Michael Burry is kind of pushing that narrative I just gave to you, and it's not like he got the idea from me. I'm the one reading this dude's tweets. Michael Burry's a pretty smart dude. He's forecasting by the second half of 2023, CPI falling as low as negative. But just like in the recession of 1974, which was a very inflationary decade, he doesn't think we're done with the next bout of inflation. So maybe between now and summer, the Fed could raise interest rates as much as another, let's call it 25, 50 basis points. And then as the market begins to slow down and kind of look to the Fed to begin cutting again, that's kind of what Michael Burry is expecting. So he thinks we'll be, by any definition, he says, in recession by second half of 2023. He's kind of, when he says by any definition, he's kind of poking fun at the current administration and policymakers who are changing the definition of recession, just like they might change the definition of a vaccine. And they're just kind of trying to build their own narrative that looks a little bit more rosy than the reality. So Michael Burry kind of saying, like, by any definition, by halfway through this year, we should be in a recession. But then he says the Fed will cut interest rates, and that's going to send risk assets to the moon as the dollar weakens. So Michael Burry's kind of anticipating things to remain pretty crappy for risk asset prices until summer, but he's expecting, kind of like everybody, the Fed to eventually get to a point where they take the interest rate hikes off the table, begin to cut interest rates, and fuel a lot more inflation, and really step in and begin to artificially support the economy again. So kind of what we're staring down the barrel of. People have blown through their stimmy money, okay? Mortgage demand is quite low right now. So, I would say the middle class and, your typical Joe Schmo is really struggling here. But do I think the Fed's going to give that guy a huge hookup and, send the value of his wage to the moon and crash these over-leveraged markets and roll off their balance sheet? Absolutely not. I think, again, inflation going forward, we could see a little disinflation, so the rate of inflation kind of slows. But I can't help but be an inflationista going forward for the next couple years. Again, we could see, maybe a couple quarters of fear and recession as the markets get hit with this lagging effect of higher rates, and then markets really start to kind of freak out and look to the Fed for reassurance, and maybe the economy does somewhat slow. But and then what? The Fed always has to come back, and that's kind of why I always default back to this party ending in essentially hyperinflation, which wouldn't be a good thing. But I'm not the deflationist and the dollar bull and the dollar suspenders, dollar under the mattress kind of guy that the mainstream would like me to be. I'm a little bit more of an inflationista than that. So that leaves me tentatively bullish risk assets. I like oil here at 73 a barrel for WTI crude, somewhere in there. Is it 73 or 83? I believe it's 73, which is quite low right now. I expected over winter energy to be dang near double what it is right now. So I'm tentatively bullish. Oil mega cap oil stocks, but not a buy or sell recommendation, but just look at the big boys who are running the energy game. And I'm tentatively bullish cryptos as that market attempts to carve out a bottom. Look, the sentiment is horrible right now, so I'm kind of looking to the future, wondering when that next bull run's going to begin. I'm still tentatively bullish. Gold, look at gold hanging out just under 1900 an ounce. Gold is very tricky to trade because when gold is making the headlines, that's when people are buying, and then it will proceed to pull back maybe 20-30% over a year period, and everyone stops talking about it, starts to ignore it, and then it kind of just sneaks back up, and by the time gold's hitting all-time new highs, everyone's like, oh my gosh, and they're chasing again. So gold is very tricky, but bullish there, and price-wise holding up really well, especially given all the hawkish rhetoric we've seen out of the Fed and all these banks that supposedly hate gold, right? So gold's doing well, bullish that. So oil, gold, crypto, and the NASDAQ, high growth tech that doesn't pay a dividend. I really like those opportunities to invest and speculate in potentially very disruptive technologies that can steal massive amount of market share. So, maybe something like Kathy Wood's, ARK fund kind of thing, or whatever Kathy Wood is dinking around with. Maybe I would look over her shoulder and take a look at that. We have the Bank of International Settlements recently, the BIS, kind of getting the framework set up for central banks to begin buying Bitcoin. Central banks buy gold. They keep gold on their balance sheet as a value store. So I guess it's not the barbarous relic they tell you, because central banks globally do hoard gold. Looks like they're setting up to do the same for Bitcoin. Looks like Goldman Sachs is really interested in bringing blockchain to Wall Street. So even maybe beyond Bitcoin, maybe some of those altcoins like Chainlink or Polygon, or could be worth looking at, but again, not a buy or sell recommendation. I will say though, my favorite cryptos in order would be Bitcoin, Ethereum, Chainlink, Polygon, and then the list kind of starts to drop off there. But hey, I'm not afraid of some of the really speculative micro cap ones too. You have like Gala, H-Bar, what else? Like Anchor, although they just went through a hack. Yeah, so a lot of these cryptos that were as much as like $1.50 each are now like 1 penny, you know, and you could throw $50 into that, which probably isn't going to change your life. If $50 is going to change your life, like, you probably shouldn't be investing yet. And you can get thousands of these things. And so, you know, I'm, as I said in my last videos, one of them, searching for deep value on the furthest frontiers in the alt space. I continue to DCA on positions that I think could do really well in the next bull run, whether it's blockchain coins for gaming, whether it's coins for adult entertainment, even though that's kind of gnarly, but all sorts of weird new industries that are kind of picking up on the blockchain. NFTs could make a comeback, Web3, DeFi, so like, you know, lending protocols. Yeah, and just kind of look at maybe what the institutions are looking at. So, you know, Matic, it seems to be drawing some institutional interest. Even an obscure one, check it out, the crypto ticker AAVE, AVE. You know, type in like AVE JP Morgan on Google and hit enter. Kind of find out if some of these more established and conventional banks, find out, you know, what altcoins they're getting interested in, and just kind of follow the money. So that's really all I got for you for right now. So I'm bullish oil going into 2023. I'm bullish gold and silver and platinum, even at 1,000 an ounce. Maybe look at platinum. And I love silver at 23, 24, where it's at right now. So yeah, the precious metals, oil, NASDAQ, and crypto. So not a whole lot's really changed for me. And I'm just kind of waiting to get these last interest rate hikes out of the way and kind of see how much damage that might do to risk assets or the real economy. And then beyond that, look to the Fed to begin to cut interest rates again, stimulate maybe UBI, and that's going to send risk assets to the moon. So I don't know about wages keeping up. I don't know how well the middle class is going to continue to get through, you know, whatever this last few years has been, but I am tentatively bullish risk assets. Could totally be wrong, no buy or sell recommendations, but I mean, that's just kind of where I'm coming from right now. So really all I got for you for right now. Hope this video finds you doing well. Like, subscribe, share, comment, whatever. You guys are awesome. You make it happen. You're the base. And we're just going to keep going, all right? I got your back. You know, hopefully that's a good thing. Nobody really knows, you know, the future, so I really want to be careful with you know, trying to be the end all be all and a real authority on things. I just want to frame everything for what I'm seeing, kind of give you my framework, and then, you know, take it or leave it, right? Thanks again. Till next time.